Lockheed Martin Corp is on our updated 2022 watch list, and today I'm going to walk you through our investment evaluation process, where we will conduct a quick company health check and run the numbers to do an intrinsic value calculation to determine our strike price. We've got a lot to cover today, so let's dive in. As value investors, we believe that when you buy shares of a company, you aren't just buying some random stocks that are numbers on a computer screen, but instead you are becoming a partial owner of that business. Therefore, we always start by looking at the company's story and financial fundamentals. And this is especially important when we think that there may be an economic downturn in the near future. When it comes to the story of the business, in order for us to even consider investing in a company, it needs to be a business that we understand, a business with honest and capable management, and a business that has strong, durable competitive advantages. These are all things that will keep the business healthy and protect our investment. We've done a good amount of research into Lockheed Martin's story, and those boxes are checked for us. Now, if you want to do your own research so that you can decide how you feel about their story, I'll link some good resources for you in the description. So now it's time to work through our valuation cheat sheet. Chris and I designed a custom spreadsheet to suit our specific process, and that's what I'm going to share with you now. The numbers that you're going to see in this video have been sourced from Morningstar.com, where Chris and I have a paid subscription that costs us about $34 a month, and this allows us to access 10 years worth of collated data on the company. There are several paid options for data providers, so you don't have to use Morningstar if you don't want to. And you can always do the steps that I'm describing even without a paid subscription. All of the data is available on the SEC Edgar website for free. You will have to do a lot more digging to find the numbers that we're looking for, but it can be done if you're willing to put in the extra effort. Regardless of which data source you choose to use, the principles of our process are the same. The guidelines for the health check and the method for figuring out our strike price aren't affected by where you get your data, as long as you get it from a reliable source. The first tab we're on is the company health check, and here we are looking at the financial fundamentals of the business. These are facts, numbers that are publicly available, which are going to tell us about how well the company's management allocates capital, the growth potential of the business, and how well they preserve shareholder value. The first thing that we want to understand is the company's ability to pay down their debt by looking at how many years of free cash flow it would take to pay off their total non-current liabilities. The lower the number, the better, but as a rule of thumb, we really like it when a company can pay off this debt in 5 years or less using their free cash flow. And if they can't, it's our cue that we need to dig in deeper. Debt can kill a company, especially if their cash flow is negatively impacted, like it very well can be during a recession. Lockheed's total non-current liabilities for 2021 is $25.92 billion. When it comes to their free cash flow, I found that last year they had approximately $7.7 billion, and in the trailing 12 months, that number was at approximately $7.45 billion. Normally, I would use whatever of these numbers is smaller. However, because of what's going on with the market these days, I am being extra conservative. So in my cheat sheet, I'm going to underestimate a bit, and I'm going to use $6.5 billion as our conservative assumption for free cash flow for this valuation. This number also brings them back in line with 2020 numbers that we found, and it gives me a little bit more comfort as we stare down a possible recession. And you're going to see me apply this conservative approach throughout this video and all other valuations that we're sharing as part of our updated watch list series. Okay, when we divide 25.92 by 6.5, it tells us that it would take Lockheed Martin a little less than 4 years of free cash flow to pay off their long-term debt. That's a good ratio, and it gives us our first check. Moving on, we want to see if they have a strong return on invested capital, or ROIC. This is the cash that they earn on their debt and equity, and we generally like to see something over 10% because it indicates to us that the company's leadership is good at allocating capital. In the trailing 12 months, the ROIC for Lockheed was 33.32, and looking back over the last 10 years, we can see that they have achieved well over 10% ROIC for each of those years. That's great, and that gives us our second check. Now let's talk about growth. We like to see revenue, net income, and most importantly, cash flow in a general upward trend. So in my table, you can see that I have entered in the data for 10 years ago and for last year. Across all of these metrics, they have had growth. Another big check. Next, we will take a look at their shares outstanding to make sure that they're not diluting the shareholder. Unlike a stock split, issuing new shares reduces shareholder value. It's usually done by companies that are needing to bring on cash to continue operations or grow the company. And we prefer to invest in companies whose cash flow can do this. We take it as a positive sign when companies are actually reducing their shares outstanding over time. 10 years ago, their shares outstanding were 0.33 billion, and in the TTM, they are at 0.27 billion. So this means that Lockheed Martin has been buying back their shares over the last 10 years with an overall reduction of 18%. That's great, and that gives us another check. And the last metric we look at is the safety of the dividend, which for Lockheed Martin is currently yielding around 2.6%. We want to see how comfortably they can pay out these dividends, and to do this, we're going to compare the amount they have paid with the same cash flow number we used earlier. Currently, Lockheed is expecting to pay out a total of approximately $3.02 billion in dividends this year. When we compare this against the $6.5 billion, we see that they are using about 47% to pay these dividends. So I'd say that their dividend is secure, and that gives us our final check. Looking at our summary table, we can see that Lockheed Martin has a clean bill of health based on the metrics that we've used. And something that I really like about this new version of our cheat sheet is that we programmed the Excel to auto-populate green or red based on our guidelines. So once we're done entering in all of our health check data, we have a very nice visual summary with notes. Okay, here's where the real work begins. Before we can do the final strike price calculation, we have to decide what number we're going to use for the expected growth rate of the company. And I would argue that the growth rate is the single most important number that we're going to plug into our valuation calculation. And it's also the most subjective. When Chris and I first started investing, this was a concept that actually took us a while to truly understand because initially we thought that the expected growth rate could be determined objectively using a set formula to get a definitive number. It wasn't until we had been doing this for a while that we really understood that whatever number anybody gives you for projected growth rate, it's just an educated guess. Essentially, we are trying to make a prediction on how we think the company is going to grow over the next 10 years. Nobody has a crystal ball, so we are all just doing our best to make an informed decision. Different investors have different ways of estimating the expected growth rate. Because it's so important, Chris and I like to do a little extra work here, and we actually compare 3 numbers to form our basis, and then we use some detailed research to help us finalize our expected growth rate figure. In our process, we always start by looking back on the past 10 years to try to get an idea of how they might perform in the future. I'm now onto the second tab of our cheat sheet, and we calculate the historical growth rate in 2 different ways based on the historical data of the free cash flow of the company. As a starting point for both methods, we plug in data for the free cash flow for the past 10 years, and for Lockheed Martin, it looks like this. To get our first result, we have applied the compound annual growth rate formula. On the right is the original formula, and on the left you can see what the formula looks like as it's embedded into our Excel sheet. Using the CAGR formula, we get a growth rate of 32.3%. I think this is a good starting point for figuring out the historical growth rate, but the problem with this method is that it only compares year 1 and year 10, and it ignores all of the numbers in between. So if you're going to use this method, please make sure that the numbers you plug in are not outliers, because if they are, this can really mess up your perception. And this leads me to method number 2 that we like to use for calculating the growth rate, and that is to plot it in a chart. We use the same 10-year table for free cash flow to create a scatter plot chart with an exponential trend line that shows the equation. From here, all you have to do is look at the exponent of the equation and move the decimal place over 2 spaces to the right, and that gives you your percentage. And this method gives us a result of about 16.8%. Chris and I really like making the chart because we feel like it is more complete and provides a very good visual representation of how the company has performed over the past decade. And it makes it really easy for us to see if there are any outliers. And if there are, it triggers us to do some extra research. So looking at Lockheed's last 10 years of cash flow, we can see that 10 years ago, they had one of these outliers. And I'm actually kind of happy that they did because this is such a good example of how the CAGR formula can lead to misconceptions about the growth rate. In 2012, their cash flow was unusually low. Because of this, the result we get with the CAGR formula is exceptionally high. Even though Lockheed Martin has had excellent growth, 32% is certainly not what you would expect moving forward. So in this instance, the chart method gives us a much more accurate representation of the growth the company has experienced over the last decade. Side note, remember that the charting methodology only works if all of your numbers are positive, so please watch out for that. Now, to get our third layer of assurance, I head over to Yahoo Finance and I check out what the analysts are predicting for the growth rate of the company over the next 5 years. And I can see that the average analyst is saying about 8.2%. Okay, so looking at our summary, we have 32.3%, 16.8%, and 8.2%. Can you guess which one I'm going to use? That's right, the smallest number, because I'm very conservative with my valuations, and this 8.2% number also aligns with our research that we've done into the company. Before we move on to the next step, I just want to say that it's really important to remember that past performance is no guarantee of future results. It's really important that you add narrative to the story that the numbers are telling you, and that you back it up with your own thorough research. And the way that you do this is by reading the annual reports, listening in on earnings calls, and watching interviews that the management gives in order to gain insights into the future of the business. You want to do your best to understand the company's products, services, their customers, competition, etc. Basically, you want to research until you stop learning new things about the company. All right, we are finally ready to start the valuation process and determine our strike price. This process is essentially our attempt to predict future value in order to decide what we're willing to pay today for those shares. It involves doing some calculations, using key numbers, and making some informed judgments. And it is so important to determine the value of a stock before you invest in it, because that's what's going to protect your investment for the long term. Remember, price is what you pay and value is what you get, and we want to know the value of a company before we invest in it. There are several ways to do an intrinsic valuation of a company. Chris and I prefer using the discounted cash flow method. So this is the method that we are going to use to value Lockheed Martin today. And I'm going to use a terminal multiple after 10 years. This means that we are going to forecast the cash flow for each of the next 10 years. And we will assume that we will sell the company and collect a lump sum. Then all of these cash flows will be discounted back to a value of today by our desired rate of return. This method requires 5 key numbers: shares outstanding, free cash flow, expected 10-year growth rate, free cash flow multiple in 10 years, and your desired rate of return. Okay, let's start with the easy stuff first. We already know some of these numbers from our health check and the work we just did to determine our growth rate. So let's plug them in now. Shares outstanding, 0.27 billion. FCF conservative assumption, 6.5 billion. An expected 10-year growth rate, 8.2%. All right, now we are on to our fourth key number, which is the free cash flow multiple in 10 years. What we're trying to determine here is the free cash flow multiple that we assume Lockheed Martin is going to have in 10 years when we're also assuming that we are going to sell the business. For this, I'm heading over to macrotrends.net to look at Lockheed Martin's historic price to free cash flow. And looking at the full numbers on the website, I can see that it's gone between 10 and 80, and its average is a little over 17. But I'm going to be conservative, and I can see that it has bounced off of 12.5 several times over the last decade. As a rule of thumb, 15 is as high as I'll ever use for a multiple. Now, if I really think that the company has a lot of room to grow, I might go a little bit higher. But in the case of a company like Lockheed Martin, which is already huge, I'm going to use a slightly lower multiple for our valuation, so I'm using 12.5. Now we need to decide what desired rate of return we want to have for this investment. And this is highly subjective because ultimately you are deciding how much of a return you want to get. I'm going to use 15% because that is our go-to rate. For some of you, that might seem high. For some, it might seem low. The reason why we like to use 15% is because we know that if we were to just invest in the S&P, that historical return rates are around 10%. So because we are taking on the extra risk and also doing all of this extra work to invest in individual companies, we want a return that is higher than 10%. This is what our cheat sheet is looking like with our 5 key numbers. And with this, we can now do our valuation, and remember, we are using the discounted cash flow method. This means that we are using this method to estimate the value of our investment based on its expected future cash flows. A discounted cash flow analysis attempts to figure out the value of an investment today based on the projections of how much money it will generate in the future. So off to the side, we've made a table and labeled it from year 0 to 10, and I have year 10 listed twice because that is our terminal year. In this row, we are creating an estimate of Lockheed Martin's future free cash flows. So we start by entering the FCF value of 6.5 billion. From here, we go down the line to grow the amount from the previous year by our desired growth rate of 8%. Here's what the formula looks like in our cheat sheet. Now remember, the second column showing 10 is there because this is the year that we assume we will sell the business. So in order to get this number, we use a different calculation. We have to take the free cash flow of year 10 and multiply it by the number we picked for the free cash flow multiple in 10 years, which in this case was 12.5. This is what the equation looks like in our cheat sheet. And 12.5 multiplied by 14.3 gives us 178.69. Now we can work on our bottom row, which is where we figure out today's value using the present value formula, which we have also embedded into our spreadsheet. Here are the results as we move down the line. Next, we need to add up all of these numbers in the second row, and when we do this, we get a total value of 91.37 billion. And now there is just one more step to figuring out our strike price, but before I share our final strike price, I just want to remind you that I'm not a financial advisor, and I'm definitely not your financial advisor. The whole purpose of this video is just to share what we are personally doing, and it should not be taken as financial advice. All right, without any more delay, all we have to do now is take 91.37 billion and divide it by the shares outstanding, which in this case is 0.27 billion, and this gives us a price of $338.41. So that's it. Our strike price is $338.41. On the day that I'm filming this, Lockheed Martin is trading at around $420. So it is overvalued for us at this time, but we are going to continue to watch it and be ready to sell put options and buy shares when it is near our strike price. Chris and I firmly believe that there are going to be a lot of great investment opportunities popping up in the coming months. So be sure to check out our other valuation videos and subscribe if you want to stay up to date with what we are doing. Would you invest in Lockheed? And if so, what's your strike price? Remember, earn more, spend less, and invest the rest, and I'll see you next time.